Franklin India Savings Plus Fund. Debt funds or fixed income funds, as they are also known, are considered to be less volatile as compared to equity funds. Typically, debt funds are considered less risky as the underlying investments have limited risk. Most debt funds primarily aim to generate regular income, while some may also aim to generate capital appreciation. They could be seen as alternatives to traditional fixed income savings or investment options like fixed deposits, etc. There are many benefits of investing in debt funds. Some of the key benefits are potential for capital gains along with opportunity for accrual income, potential to outperform inflation over medium to long term, liquidity and tax advantages. Relatively less volatile return profile may offer regular income, transparent and well-regulated, professionally managed. There are two ways in which the debt funds generate returns. First, through interest income from the underlying securities in the fund portfolio. Typically, higher the credit risk, higher is the interest income and vice versa. Credit risk is the probability of the principal and interest being paid on time. In other words, higher credit risk is being compensated by higher interest income. Second, through capital gains, which arises due to change in prices of the underlying securities in the fund portfolio. Typically, prices rise when the interest rates fall and vice versa. This is also known as interest rate risk. Debt funds may be classified on the basis of their indicative investment horizon and their investment strategy. On the basis of indicative investment horizon, debt funds can be classified as liquid and ultra-short-term funds. These funds are suitable for investors who have idle money but for a very short-term investment horizon, ranging from a few days to a few months. Then there are short-term and medium-term funds, which invest in short to medium maturity debt securities and are suitable for investors with an investment horizon of 1 to 3 years. And finally, there are long-term funds, which invest in government securities and long maturity corporate bonds, which are best suited for investors with an investment horizon of 3 years and beyond. On the basis of their investment style or strategy, debt funds may be classified as high credit funds. These primarily invest in government securities, corporate bonds and other fixed income instruments with a high credit rating such as AAA or equivalent. The objective is to minimize the credit risk. Managed credit funds. These primarily focus on corporate bonds with credit ratings generally below AAA or equivalent. These funds aim to generate higher interest income by taking higher credit risk. Debt funds can be positioned on the basis of a combination of credit risk and interest rate risk in their portfolios. The chart shows the positioning of various categories of debt funds with respect to credit risk and interest rate risk held in their portfolios. For example, a high credit liquid fund is typically positioned as a fund which carries a low credit risk and a low interest rate risk. Similarly, a managed credit medium-term fund is typically positioned as a fund with a higher credit risk and a higher interest rate risk. Ultra short-term bond funds were earlier known as liquid plus funds. While liquid funds are one of the least risky categories among mutual funds, ultra short bond funds are suited for those looking for better returns than liquid funds, but with a relatively higher risk. They also come with a slightly longer investment horizon than liquid funds. Typically, their minimum investment horizon is 3 months, and one can stay invested for up to about a year. The general objective of such funds is to hold interest-bearing securities and aim to provide steady returns with low volatility. One may park a small portion of their funds earmarked for emergencies into ultra-short-term debt funds. Let's look at the key benefits of investing in the Franklin India Savings Plus Fund. This fund is an income fund which endeavors to invest at the short end of the yield curve by primarily investing in floating and short-term fixed-rate debt instruments with high credit rating. It aims at maintaining high liquidity and credit quality. endeavors to minimize the risk arising from interest rate fluctuations. Ideal investment horizon. Since the Franklin India Savings Plus Fund is an ultra-short-term bond fund, one could look at an investment horizon for a period greater than 1 month. Every investment you make must ideally be linked to a financial goal, and this goal could be of varied durations depending upon your investment need. This fund could be considered as an investment option if one is planning on investing for their short-term goals or parking of contingency funds. Who should invest? Those with a moderately low risk appetite and a very short-term investment of 3 months and above. Those who have received large cash flows or have a surplus pending deployment in an equity fund or other avenues. Those who have money parked in a savings bank account could consider investing in this fund. Investing in this fund could be a good alternative to investing in short-term deposit. Let's take a look at the tax structure. Liquidity. You can redeem your investments in full or in part on any business day. The redemption amount is normally dispatched within 10 working days from the date of redemption. You could either receive this amount as a direct credit into your registered bank account or as a physical check which you can deposit into your registered bank account. Let's get to know some fun facts of the Franklin India Savings Plus Fund. For more information, please feel free to contact your mutual fund distributor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.